sure most of you are looking forward to the end of this presentation rather than the presentation itself. But let me just try and make this as short and brief as possible, and at the same time cover some of the key issues which I really wanted to discuss. So in terms of what I really want to do is to cover two aspects. As far as inbound M&As are concerned, look at some of the key issues. Rekha did bring up the issues relating to withholding taxes and all. So I'll just spend a little bit of time on that before I go on to deal with some depth on outbound acquisition or transactions also. Again, I'm pretty sure you have seen this earlier today also when Mr. was doing this presentation. But the moment when we are talking about a cross-border transaction, we are no longer looking at just the Indian law or what are the Indian judicial precedents or the legal position as far as the transaction is concerned. You're looking at more a holistic perspective. You're looking at, if for example, if you have a US entity which is acquiring an Indian entity, you're looking at, okay, what would be the tax consequence in the US? What would be the tax consequence if intermediate SPV is used, let's say in Mauritius, and what would be the tax consequence in India when you're really looking at structuring the transaction. And again, I'm talking about tax, but you don't just look at tax, there are other aspects to it, whether it's international law or corporate and commercial laws also, that you do need to keep in mind while you're looking at structuring these transactions. In fact, interestingly enough, when you look at it, one prime reason, if you look at why US companies actually invest in India, not directly, but a lot of times through an intermediate SPV like Mauritius, it's more because of the anomaly that is there in terms of the source rules that are there in the US and in India. Because as far as US taxation is concerned, the moment you are a US tax resident, irrespective of where you're selling shares, you're going to be taxed in US. It's not the situs of shares that matters, it's the situs of where the person is resident. Whereas as far as India is concerned, we look at the situs of the shares also. Which is why you always end up in a position where if you have a US company investing directly in India, you have a potential tax implication that's going to be happening in both jurisdictions, especially when it comes to capital gains. And there are going to be credit issues, which is one reason why a lot of people actually prefer investing through Mauritius. And that's, again, this is more in the context of the fact that I know a lot of people, there is a lot of problems happening on the use of intermediate jurisdictions. But again, what we do need to keep in mind that it's not always driven by non-taxation as much as avoiding double taxation. I think that's something that everyone should keep in mind. Again, I'm going to sort of skip over some of the other slides, but more in terms of the key issues that are really there when we are looking at any acquisition transaction in India. The first one is indirect transfer of assets. This, of course, you do have the Vodafone case, which is more, I would call an extreme end of the spectrum, where, of course, in the Vodafone case, you had one Cayman company transferring the shares of another Cayman entity to a Dutch entity. And the only underlying assets, if you look through all the intermediate jurisdictions, there were a lot of companies in Mauritius and other jurisdictions. The only assets were really in India. And where you had the issue of whether the transaction can be chargeable to tax in India. So I would see a Vodafone as a more extreme case, but we have seen a number of other transactions after that, where the biggest concern is that what happens if a key business is in India, or a substantial part of the business is in India. There are also business activities happening in other jurisdictions. In that case also, as a buyer, since it actually was a withholding tax question in Vodafone, as a buyer, would you be concerned, or as a seller, would you push back as much as possible? So that's usually a question that arises in a lot of M&A transactions, where even if you have a domestic US M&A transaction, where there's one US acquirer acquiring another US company, because of the fact that the target actually has an Indian subsidiary, you still have a lot of clients coming up with the same issue. Is there going to be a risk for us? Should we be withholding tax on this transaction? Now, and that's where really it's more of a judgmental call. I would actually go into a couple of case studies on that point. But again, as I said, in terms of some of the key issues, you do have the indirect transfer of assets. Applicability of treaty benefits, less than 10 days back, you did have the Aditya Birla Novo judgment also come in, which pretty much again sort of changed things around after you had the E-Trade advance ruling and everything. People are having some degree of comfort, okay, it's not as bad as things though. Though E-Trade did go up to Supreme Court, and the next thing you know, you have the Aditya Birla judgment also coming in. Where what the Bombay High Court really said was, at least again there it was a prima facie determination that they had made, where they said that in that case, AT&T, which had actually had a 100% SPV in Mauritius, which held shares in Idea Cellular. Two transactions happened. The Aditya Birla Group bought the shares of Idea Cellular from the Mauritius entity. The Tatas bought the Mauritius entity from AT&T. And in respect of both the transactions, as far as Aditya Birla was concerned, there were proceedings instituted as a rep SSC because Aditya Birla had already gotten a nil withholding certificate at the time of consummation of the transaction. But subsequently, proceedings were initiated against Aditya Birla as a rep SSC. Against the Tatas also, there was a withholding tax issue that was raised. So in both of these situations, again, what really the court went into was, they said that, look here, this was essentially a JV agreement that was entered into between AT&T and its predecessor actually, and AT&T had taken over the company. So this was actually a JV agreement that was entered into by the US company along with Aditya Birla initially, and all the rights in respect of the JV agreement vested with AT&T. And the Mauritius entity was nothing but a permitted transfer